Friends, in this session, we will understand what is fund flow analysis. Fund flow analysis is nothing but analyzing a statement called fund flow statement. That statement would tell us the movement of funds which can be used or analyzed by the management to take some critical decisions. We'll see what it is. The fund flow statement would basically tell what are the long-term funds mobilized by the company and what are the long-term uses. So long-term funds have been mobilized and they have been used for long-term purposes. So there can be a difference. I mean, there can be either a surplus or there can be a deficit. If there is a surplus, that surplus can be used for funding the business working capital purposes. I mean, changes in working capital requirement. That is, if the working capital requirement increases, this surplus can be used. Similarly, if the long-term sources are less than the long-term uses, then there is a deficit. Then now the question is how this deficit was funded. Obviously, that would have been funded from changes in working capital. Here, instead of increase in working capital, it will be decrease in working capital. So the funds which are meant for running the business or say running the routine operations were used for long-term purposes. Let's understand in a better way. Look at this balance sheet. See, balance sheet will have long-term sources, long-term uses. Long-term sources on liability, long-term uses on asset, and short-term sources and short-term uses. See, if the long-term source increases, it means a fresh funds and come in, so it is an inflow. Similarly, if the long-term uses decreases, it means some big assets have gone out or sold off, so you are going to get money, so it's an inflow. Again, if the long-term sources decreases, it means you are making payment for the funds raised, and if the long-term uses increases, it means you have added new assets for which you have to make payment. So in both scenarios there is an outflow. So if there is an inflow, it is called source of funds, and if there is an outflow, it is called use of funds. If source of funds are more than the use of funds, the surplus can be used for funding the increase in working capital, and if the use of funds is more than the source, then there is a shortage, and that shortage is funded out of decrease in working capital. So to summarize, fund flow statement would basically put all the sources of funds on one side and uses of funds on the other side. So the sources are basically long-term funds and uses can be both long-term uses and working capital. So if there is a surplus, it can be used for working capital purpose, and if there is no surplus, if there is deficit, what will be the scenario? Look at here. If the uses are higher and sources are short, okay, then probably the long term is funded out of working capital funds. So this is what the fund flow statement basically gives us the picture. Now, for analyzing fund flow statement, what are the information we require? Number one, we should know what are the sources of funds. Number two, what are the uses of funds, and number three, working capital movement. So what could be the possible ways for raising or sources of funds? One is raising long-term funds. I mean, long-term funds means it can be from owners in the form of equity, it can be from debentures, it can be from term loans. And the other possible is from business operations, funds from operations, that is profits before depreciation and tax. And the third possibility is disposing the long-term assets. So in all these three combinations, funds can be raised, and these funds can be used for say paying long-term funds back to say banks, the term loan repayment. It can be used for paying the owner's dividend and the government tax, and it can be used for purchasing the long-term assets, factory, land, building, machinery, everything, etc. Next, it can also be used for working capital. I mean, there can be either usage or there can be a source from working capital. If there is an increase in working capital, it becomes use, and if there is a decrease in working capital, it becomes source. We are going to see all that. So what are the documents required for fund flow statement, or the information required for fund flow statement? Number one is income statement of the current year. because that would tell us what is the profit generated. And number 2 is 2 years balance sheet. As I told you, the income statement would give us what is the funds generated from operations, whereas the 2 years balance sheet would give us long-term sources between these 2 years, long-term users between the 2 years, and what are the changes in working capital. So first we'll understand what is this funds from operation, right? See, funds from operation is nothing but profit before tax, and basically it's a long-term source. Why this funds from operation is a long-term source? Because this is the portion payable to owners, and owners can have the choice of having it in the business for a longer period, so it is a long-term source. So funds from operation is nothing but profit before tax added for depreciation, amortization being a non-cash items, and adjusted for loss on sale of assets or investment, because this loss is associated with long-term use. Okay, it is associated with asset movement, it is not associated with funding movement, so it is added back here. Similarly, profit on sale of asset is also removed because that is associated with assets. Here we are talking about profits from operation. The sale of asset or profit on sale of asset, loss on sale of asset are not out of activities, they are non-operating items. We are talking about funds from operation, they are non-operation items, so we are removing them. So this is what funds from operation is all about. Now to understand what this fund flow analysis is all about, we'll take a real example that will be in next session.